The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to the BetaShares webinar for today, the ABCs of ETFs. We're just going to give people a couple of minutes to join us, and we'll get started in approximately 2 minutes. Thank you very much. Good afternoon, everybody, and welcome to today's BetaShares educational webinar. And today we're covering the ABCs of ETFs. We're covering this because we've had a huge amount of demand from our various clients and prospective clients just to understand the absolute basics of ETFs. So this particular session will really be made for and has been developed for the beginner. Obviously, it's a good refresher course for those who know a little bit more about ETFs, but this really is a very basic session to talk about the basics of ETFs and some examples of how you can use them in your portfolios. Now, before getting started, we just want to make the point that this information is not personal advice. We haven't taken into account anyone's particular circumstances when preparing this material. And if you do have an interest in any particular BetaShares ETF or any other product we mentioned, please do look at our product disclosure statements for more information. So moving along now, just in terms of some basic information about this webinar, this recording will be sent to all registered attendees of the webinar. So whether you make it or not, you will receive this recording. And you probably will see there's a little widget you are using to access this webinar. And the purpose of that is really to give you a bit of extra information. If you have any questions you want to ask, please do so by typing it into the questions section, and we will endeavor to get back to you at the Q&A section of the webinar. Also, there are some handouts. You'll see a section called handouts where we've got 3 basic bits of information about what an ETF is, a little bit about our range of ETFs, and a comparison of ETFs and managed funds. So without further ado, I'm going to introduce our presenter today. For many of you, he will be familiar to you. He's our Chief Economist, David Bassanese, and he's really the perfect person to be giving this webinar as he is the author of the most comprehensive book on investments in ETFs, the Australian ETF Guide, which I'd recommend if you have an interest in looking deeper into the ETF industry. David was a decade-long journalist at the Australian Financial Review before joining us, and previously has been involved as a working economist at places like Bankers Trust and Macquarie Bank. Before handing over to David, I'm going to start by just sort of getting a sense of the type of people we've got here. And so there's a poll you'll see on your screens there asking you a question. And that question is, have you invested in ETFs before? I'll just let that run through for a few seconds. Please make your votes, that'd be great. Thank you very much. I'll just do another question before I provide the answers to that last one. So the next question is, how would you describe your level of knowledge of ETFs? It's an interesting thing to see what type of people we've got here. It might help David to describe a little bit more about how he talks. And thank you for that, for those who voted. And finally, interested to know what the category of ETFs that are of most interest to you are. So if you just select, you can click more than one here, types of funds that are that you may be interested in. All right, so thank you for that. Now I will just show you what people have said. The first question we asked is, have you ever invested in ETFs before? And you can see actually it's reasonably high level of people who have. So more than half of the audience have invested in ETFs before, but obviously still interested to find out more about them. But still, you know, a good 40% who have not. And then the second question is, how do you describe your level of knowledge? And obviously the majority of people believe they've got a basic level of knowledge, and a number of people say they have an intermediate set of knowledge as well. And the category of ETFs that interest them, well, that's quite telling as well, because really a very, very significant amount of people are interested in global shares. And of course, the data that we have indicates that as well. So also Australian shares popular as well. So thank you for that. But that bit of fun done, I will now hand over to David to take you through the basics and the ABCs of ETFs. Thanks very much.
Thanks very much, Alan, and thank you everybody for listening in today. I hope you'll find this informative. So this is basically the outline today. First, we'll get into what is actually an ETF and how it's distinguished from other types of investment funds, managed funds in the market. Just a bit of an update in terms of the ETF industry, both globally and in Australia. And then, the rubber hits the road at the third section there, how you can actually give you some ideas for using ETFs within your portfolio, some of the different types of investment opportunities that are available using ETFs. So firstly, let's see what the government officially says. If we just go to the next slide there. So if you were to go to the Money Smart website, it actually does say what it thinks exchange-traded funds are and managed funds are listed investment companies. So firstly, let's remember what a managed fund is. It's basically a way in which money from different investors is pulled together into a fund. Then a professional investment manager basically uses that money to buy and sell either shares or bonds or whatever, and then pays out distributions of income on a regular basis. And the underlying value of your investment over time will basically reflect the market price of the underlying securities that fund is invested in. So that is a traditional, typical managed fund. Now, exchange-traded funds, as it indicates there, are basically another type of managed fund. So first and foremost, an ETF, despite the sometimes mnemonic that people get concerned about, the ETF mnemonic, it is at the end of the day just a managed fund. One of the key differences, though, is that it is bought and sold on the ASX, just like a company share. There are some other differences, which I'll go into in a minute, but that is the key issue. It's a managed fund that you can get access to on the ASX. Now, there are other types of funds available on the ASX already, which are called listed investment companies, or LICs for short. So some of you may be familiar with listed investment companies. Now, the structure of those are different from an ETF, and again, I'll get into that a bit later, but an ETF is like a LIC in some regards, in that it's a managed fund, but it's also quite different, and it has, I think, a lot of positive features over and above the current LIC structure that exists on the ASX. So just with that, so let's go back to managed funds. So look, managed funds, really, let's remember these have been around now for probably since the early 20th century. Really a great they get a lot of negative publicity now about, fund managers, earning high fees, not beating the market, all these sort of issues. But at the end of the day, managed funds were originally a great invention. They basically allowed investors to pool their money together and then through one investment get diversification to a whole bunch of different shares or bonds. So that ready diversification, one fund you can have access up to several hundred stocks if you like. It is also a professional investment. You also then get access to a professional investment manager who basically decides how to invest that money. And last but not least, regulated investor protection. So that most managed funds, or all the asset regulated managed funds in Australia, the money that do go into these funds are ring fenced in the sense that managers can't basically take that money and head off to Bali or whatever. It's sort of set by a independent third party custodian, kind of looks over that money. And should a fund manager become insolvent, for example, that money is ring fenced and held in trust for the investors, so they basically are able to get their money back. So they are important features of all managed funds, all asset regulated managed funds in Australia. And so give credit where credit is due, that managed funds are a great invention for those that don't want to basically invest directly and have all the headaches associated with that. But there are challenges with managed funds, and I've just listed them there. So I've broken up the current, before we even consider ETFs, the typical way in which you can get a managed fund at the moment is an unlisted active fund. There's an unlisted passive fund. So an active fund is a manager basically that's trying to beat the market using their investment skills and their sort of analysis of company balance sheets and whatnot to invest in stocks they think will beat the market. You've got the passive funds that basically just invest, in a market index or underlying securities that will track an underlying index. And then you've got the active listed investment companies available on the ASX already. Now the challenges are, basically one of the challenges for all active funds, they do have the challenge of basically often not offering good value for money, because as we know, surveys suggest a lot of active managers at the end of the day struggle to beat the market. So if you're paying a high management fee for a fund that basically can't beat the market, then that's not very nice. The one that stands out in that regard is then a more passive fund, which does arguably in that case offer value for money. Now, the other challenge, challenge that does arise with funds is the fact that they may not trade near their NAV. Now, the NAV is the underlying market price of the securities that the fund invests in, be it like BHP or CBA or whatever. Now, this is a particular challenge for LICs. So listed investment companies available on the ASX, they are what's known as closed-end funds. Without going into the details, it basically means that when there's more investor demand for a LIC, there's no new money that can go into that fund, and basically the market price of that LIC will be bid up relative to the underlying net asset values of the shares or bonds that LIC holds. And so LICs can trade at significant premiums or even discounts if a LIC becomes quite unpopular to the underlying net asset value, which is, again, one of the challenges. Now, unlisted funds don't have that problem. Basically, if you have an unlisted fund and you want to cash out of that fund, they will basically stand ready at the end of each trading day to redeem units at the net asset value of the fund. So they are positive features of those funds. The last one is ease of access, the last challenge, I guess. And so the LICs in this sense have a benefit in that, they are easy to access and that you can invest on them through the ASX. Whereas for an unlisted fund, and those of you that have gone through this process will know what I'm talking about, you can get very complicated application forms such that, you've got to have a photocopy of your driver's license, you've got to get a, justice of the peace to verify it's a, certifiable copy of your driver's license, all this sort of stuff. So it can be quite a complicated process to invest in unlisted funds in terms of paperwork. So these are the challenges. So as you can see, basically all the different funds out there have various costs and benefits in terms of the way in which they're structured. Now, if we look at ETFs, you basically see the ETFs are basically structured to solve all of these problems. Firstly, they give you value for money, and that most ETFs are basically passive funds and they track underlying indexes. So you're getting access to these markets at very low management fees, as low. Our last fund we've launched is 7 basis points. I'll talk a bit about that later. But on average, you can get an ETF for probably about 50 basis points or less, versus the average fee for an actively managed fund in Australia is something like 1.5%. So good value for money. Again, and a big difference between an ETF and an active LIC is that ETFs are designed to trade at their NAV. because these are what's called open-ended funds. So when there's a strong demand for an ETF on the market, basically we are able to create more units of that ETF and then go out and buy more shares so that they do trade close to the net asset value. So basically what that means is that if the underlying market value of the shares of that fund go up by 10% in a given period of time, you can be more or less assured that you can basically sell your ETF if you want at close to that 10%. You know, the value of that ETF on the market will have also increased by about 10%, which is not the case for a LIC. There's no guarantee that the LIC will trade near net asset value. So again, so in that sense, an ETF is similar to an unlisted fund, and very different from a LIC. Last but not least, it shares the benefit of ease of access as does a LIC. So, you know, again, so it's basically offers you good value for money in that it tracks an index and tends to be passive, structured such that it trades near its net asset value on a day-to-day basis, and you get ease of access on the ASX. So that's why ETFs, both in Australia and globally over recent years, are proving so popular. They're basically, you know, as I've likened them, they're a better mousetrap. You know, it's a managed fund, but it's probably the best design type of managed fund that's been invented. Now, so let's just, again, just to draw some of the distinctions, if we go to, if we just go to this slide. So just again, to reiterate the differences between an ETF and other typical managed funds. So a traditional managed fund tends to be unlisted. It can either be closed-ended, in which case it can, you know, not necessarily trade near its net asset value, or can be open-ended. And a typical managed fund is open-ended in that regard.
And Dave, let me just ask you a couple of things. There's a couple of questions coming in here, just given that it's a 101. So you mentioned two things. You mentioned net asset value and basis points. Can you describe what those are, please?
A basis point, sorry, I said 7 basis points. So a basis point is basically a fraction of a percent. So 100 basis points is 1%, essentially, and 50 basis points is like, you know, 0.5%. So that's what I mean by that. So it's just a fraction of a percent. Net asset value. So the net asset value is basically the market, the underlying. So let's consider a fund that has 10 stocks in it, and they're basically the top 10 stocks on the ASX. Now, and they're all equally held, so, you know, 10% in each of those stocks. Now, the net asset value of that fund will be the market price of each of those shares times by 10%. So it's like the underlying, it's the underlying. Another way of saying it's like the fair value of the managed fund. So again, it's basically, if you were to basically, you know, end the fund and sell off all the assets, the net asset value is what you should get back, because you're basically selling all the underlying securities at their market price. Hopefully that answers that question. So just going back to this, as I said, the key issue here is an ETF is basically, it trades on the ASX like a LIC, but it's open-ended like a traditional managed fund. And so the fact that it trades on the ASX and it's open-ended gives it that very unique quality that basically beats, you know, overcomes all the problems that I was discussing before in terms of more traditional managed funds. So what is an ETF? So let's just look at ETFs more specifically then. I mean, again, it shares a lot of features with managed funds. So an ETF basically tracks, now again, an ETF is typically, I mean, it can be a little bit different, I'll talk about this later, but a traditional ETF, it tracks an underlying index. And an index is basically, what is an index? An index is basically when you think about it, it's actually a rule. Like, for example, the ASX 200 is an index that tracks the top 200 companies in Australia on the share market, weighted by their market capitalisation. So the rule for that index is basically the index will include stocks that are in the top 200 stocks by market cap, and the weight in that index will be the relative market cap of each of those stocks. So that is a rule for deciding which stocks should be in the index and what percent of the fund should be invested in the different stocks. So an index is basically a rule to determine how to buy things. And the beauty of that is that it's pretty low cost and that you don't need to hire, expensive analysts to say, we think you should hold a little bit more of Westpac and a little bit less of BHP. You just have this fixed rule that will decide what share of those stocks will be in the index. And so that applies to the Australian market, international shares. ETFs, there are indexes available on Australian shares. We'll get into some of that. International shares, commodities, currencies, cash and fixed income, bank hybrids, different industry sectors. And all of them, basically an ETF can track, basically hold the stocks that index is composed of. And as a result, you can get access to the market performance of that index. And as I said, so it is a managed fund in that sense. And the other feature basically is it does trade on the ASX like a company share. So it's relatively simple. It's transparent. And again, the other feature of an ETF, because it is a passively managed fund, I mean, we don't care that we don't need to sort of have any secrets here in terms of what we invest in. Whereas with an active manager, I mean, they have a lot of intellectual property invested in choosing what they think are the best stocks. They necessarily don't want to reveal that to the market all the time. So it's not as transparent. Whereas us, if we're going by a fixed rule in terms of what would be in that index, we can basically make available on our website daily all the individual stocks or bonds that each specific ETF holds. It's very transparent in that regard. And also, as I mentioned, very cost effective. So, the MERs of these funds are typically quite significantly lower than actively managed funds that you may have to buy off market. And also even a lot of LICs, a lot of LICs that trade on the market. Some can trade at, relatively high fees and have performance fees attached to them and whatnot. So the advantage of that gets back to that passive versus active debate. And again, the diversity, and there's a lot of diversity. The beauty of ETFs now is it's opening up markets and investment strategies that investors would have struggled in the past to get access to. So not only Australian shares, but international shares. And again, I'm going to show you some great opportunities later where you can invest in international shares now or indexes very easily from the ASX. And you can also access bonds, bank hybrids, cash opportunities, commodities like gold or oil, lots of different opportunities. Now, in terms of it, this next slide is just to emphasize this point about index tracking. So this is like the NASDAQ 100 index, for example. We have an ETF that does track the NASDAQ 100, which is an index, a US index of mainly technology stocks. And basically what you see there, the orange line is the actual the value of the ETF, the net asset value of that ETF has done over time, and the grey line is what the actual NASDAQ index itself has done. As you can see, it's like a very, very close relationship over time. So that is that benefit. So if the NASDAQ goes up 10% in a given period, you more or less can be assured that the ETF value on the market will have gone up by pretty close to 10% as well. So how to buy an ETF, just to reiterate this point, again, they are all available on the ASX. First and foremost, you need to have a share trading account. So if you do have a share trading account, basically you just need to know the code of the ETF. You type it in, so the code for the Commonwealth Bank is CBA. So if you type that into your share trading account, bang, the CBA comes up and you can buy units in it. In the case of the NASDAQ, for example, NDQ is the code. So if you were to type NDQ into your share trading account, up would pop the BetaShares NASDAQ 100 ETF, and then you could buy units in that fund. So again, just as easily as a company share. And so, so the different options there in terms of getting access to ETFs. You need to have that share broking account. I mean, we know opening a share broking account can be a bit of a complicated process, but the thing is, once you've got it set up, basically you don't need to do it again. You can then buy any shares or ETFs that trade on the market. Now, so before we move on, just to look at some myths. So, I mean, if you read in the newspapers, you may hear, various things said about ETFs. Typically some disparaging comments. Let's be honest. Which I think, partly is because of, at the end of the day, I think there's a little bit of, we are a bit of a disruptive influence in the market, I guess. A lot of the traditional kind of managed fund managers, have seen the strong growth in ETFs, a little bit concerned. So there's a bit of disparaging talk going out. I just want to sort of just use this opportunity to dispel a couple of myths. Firstly, the ETFs are a fad. I mean, they're certainly being more and more well known in Australia, but they've been around a long time. They actually started as a concept or as an investment structure globally way back in 1990, and they've actually been on the Australian market since 2001. Also, ETFs are somehow riskier than managed funds. I mean, people talk about, ETFs holding a lot of derivatives or having, extra risks that other managed funds have. Again, largely a misnomer. Most ETFs typically that track an index are basically going to hold the same types of underlying securities, be those shares or bonds, as would a traditional managed fund. So there's no real difference in that regard. Again, ETFs, as with managed funds, can hold derivatives if they want to. A managed fund, they actually don't specify to a great degree. There's no real distinction whether they have derivatives or not. In the case of ETFs, you actually do have to call them a different name. You have to call them synthetic ETFs if you have any sort of what do I mean by derivative? That's like it's like a derivative is like a contract, for example, to buy oil, to buy exposure to the oil price. You buy an oil future, which is defined as a derivative. Whereas in Australia, you need to be called a synthetic in that case, so the labelling is quite clear. And B, in Australia, there's only 3 ETFs on the market that could be described as synthetic, and they're basically commodity ETFs, because that's the only real practical way that you can expose to things like, different commodities like oil, agricultural products, and things like that. And even then, they are very highly cash backed. They're basically mark to market on a daily basis. So each of those ETFs are, backed by cash, largely on a day-to-day basis. The other myth, ETFs can't outperform the market. I mean, it's said here, ETFs are dumb money. Basically, you're just going to get market performance. 2 points to say, and by market, I mean market cap performance, like say the ASX 200. 2 points are, firstly, outperforming the index itself is not that easy. I mean, a lot of active managers out there, surveys show consistently struggle to outperform the market over any given time in any case. Secondly, we think it is possible to outperform the market in the sense that when the market is defined as a market cap type index, just through having smarter indexing, and I'll show you an example of that later. But I think the so-called smart beta, these are called smart beta strategies, where you have a different way of indexing, which can give you, different risk, different return profile over time, and often better than what the market is achieving. ETFs are illiquid. Again, if you go to your website and look at and call up an ETF, you may see relatively small, for some ETFs, relatively small bid and offer volumes, and you say, oh, these aren't very liquid. But again, that's a misnomer, because there is actually a lot of underlying liquidity there. Basically, all ETFs have professional market makers behind them that stand ready to provide more units to the market as required. And so what you tend to see is like a trading inventory of a volume of stock of units for bid or offer that are likely to meet the next 1 or 2 trades on the market. And now if there is a trade that goes through, the market maker will basically then almost immediately replenish the stock available for sale or purchase on the screen almost immediately, unless there's been any change to the underlying market value of the securities. So basically, what you see on screen is not indicative of the underlying liquidity of these ETFs. There is a quite strong underlying liquidity to all of these to ETFs in general. Third myth is, there's talk about this strong growth in ETFs and again, I'll show you this in a minute, but the strong growth in ETF demand over recent years is contributing to market volatility, and it could actually lead to like a bit of a market meltdown when everyone decides to sell their ETFs and all the point here is that a lot of the demand for ETFs over recent years has come from more traditional managed funds. So it's not clear that there's been a net increase in demand for, say, investor participation on the share market, for example, because although ETF funds under management has grown strongly, funds under management through unlisted actively managed funds has been shrinking. So there's been that switch that's been going on. And just in terms of like market meltdown, if there is a market meltdown, look, the underlying net asset value of these ETFs, as I said, will obviously fall along with the share prices of the companies they invest in. But that is a function of the market going down. It's also will be true for all managed funds basically. But the beauty of an ETF is that, again, market makers will be around, and you should be able to get out. Provided you trade carefully, get out at close to the net asset value should you wish to during a market downturn. So there's no ETFs are actually no real different from an unlisted managed fund in that regard. Again, to get more information, I've only skirted over the top of that in the interest of time. If you are concerned with some of the myths about ETFs, I suggest you go to our website and look to the insight section of our website. We have a number of blogs there, and there's a few blogs there about tackling some of the ETF myths that are out and about. So if you do want more information on that, I suggest you go to our website and look up on the insight section. You'll get a lot more information. So just to reiterate then the advantages of ETFs, cost effective, diversification. One ETF gives you that diverse access to a number of securities within an index, the ease of access on the ASX, the transparency, and lots of choice. So, these are really, I think, again, a better mousetrap. It's just a better way of investing, and I think you'll see basically a gravitation to this being, probably the way in which most people will be investing in a few years. I think even many traditional funds will convert themselves into ETFs over time. So just some considerations. Obviously, there are investment risks in investing in ETFs, so they will fluctuate in line with market developments. Obviously, this is not personal advice, so if you think you need more professional advice here, definitely seek it out in terms of professional advice. And past performance of an ETF is no guarantee of future performance. So obviously that's a caveat that the Nasdaq, for example, has been doing very well. Will come a time where it corrects along with other markets around the world. So we don't pretend to suggest just because it's done well in the past it's going to continue to do well. Well, I think over the long run all your stocks will generally do well, but there will be corrections from time to time. Again, and also if you want more information, each ETF as a managed fund does have a PDS associated with it, so you can basically get access to that. And read up more about the relevant risks for each of the ETFs. Now, final thing in terms of ETFs, and one thing that may, I guess, confuse a few people is there's a lot of different names bandied around. So I've mentioned exchange-traded fund at the moment. There are other things now called exchange-traded products, exchange-traded managed funds, active exchange-traded funds. I mean, you may have come across all these different terms. I just want to sort of clarify the differences here for you. If you just go to the next slide, basically this explains it. So, look, the way to think about it is the umbrella name for these type of securities, these types of funds are exchange-traded products. So it's actually ETP is the broader name here. And exchange-traded products are basically they need the two characteristics that define an exchange-traded product is A, they trade on the ASX, and B, they're open-ended, and that they're designed to trade at close to NAV. So that's what distinguishes an exchange-traded product from a LIC, the fact that they're open-ended. Now, but within that, there are different investment strategies that these exchange-traded products can follow. So as I said, if it's a largely passive type of investment strategy, so it's tracking an index, it's called an ETF. So that's what I've been talking about so far. An ETF tracks an index using pretty fixed rules, no discretion, and an example there is our RAFI Australia 200 index, the code there being QOZ. It tracks the top 200 stocks in Australia, weighted by their underlying financial metrics such as book value, earnings, cash flow. It doesn't use market cap, it uses underlying financial metrics, which we think is a better way of doing things, as I'll explain in a minute, but it is still an index. More rules-based strategies. So here's slightly another way is to basically have you don't just track an index, but you have like these rules that determine what sort of stocks you would buy. An example there is like our WiMax fund. So WiMax is basically a fund that holds the top 20 stocks in the index, and then it basically sells calls over the top of those. Calls are basically an option. I won't go into the details here too much, but basically it's a rule that generates extra income for the fund by selling options over the top of the fund to track pretty good income as a result. But that's an example of a rules-based investment strategy. And in that case, they're called exchange-traded managed funds. Last but not least is one of the newer entrants into the ETP industry over the last few years are purely discretionary funds. So these are the active managers who formerly used to be, unlisted or LICs that have converted themselves into exchange-traded funds. And so these can be purely discretionary funds. And an example there is our Legg Mason Equity Income Fund. Again, it's a fund that is designed to invest in companies on the market that offer fairly good dividend yields and have good and are expected to generate good growth in dividends over time. Now, it can be an actively managed. The difference with an actively managed fund, we don't get access. They're not as transparent in the sense that they don't reveal their underlying portfolio holdings on a daily basis. It's basically with a lag of around 3 months. So that's to protect their intellectual property. They spend a lot of time picking the good stocks. They just don't want to tell everybody what those stocks are on a continuous basis, because otherwise people can go ahead and buy those stocks without buying the fund. But nonetheless, they are designed to track the net asset value of the stocks they invest in. So again, a big difference with a LIC. So if you buy an actively managed fund like Inc. and the underlying market value of the shares that fund holds goes up by, say, 10% over a 6-month period, the market value of that ETF will go up by pretty close to 10% as well. So you should be able to get a 10% return on that ETF, which is a big difference with a LIC. So that's essentially the differences. They're all on the exchange. They're all open-ended in that, so as a result, they should all guarantee prices trade close to their net asset value. But the investment strategies of them can differ from a purely passive type strategy to a rules-based strategy to a purely discretionary strategy. So the beauty of ETFs is that they are flexible enough now to cater to different investment strategies. It's no longer true that an exchange-traded product in this case is just a passive fund. They can be quite active as well. So again, just to emphasise now the choices available. So just got here an example of, we here at BetaShares, we have about 45 funds now on the market covering Australian equities, global equities, currencies, commodities, bonds. So we have a floating rate bank bond index. So I'll talk about that in a minute. Bank hybrids. So if you like bank hybrids and you want to invest in them through a fund, we have a bank hybrids fund. And we have funds that basically designed that go up when the market goes down, like short funds. We have geared funds. So if you actually want to get geared exposure to the market, we have some funds that cater to that as well. So again, the beauty here is that just the diversity of choice that is available. So now, hopefully, that's really an overview of ETFs and their unique structure and a lot of the benefits I think they bring to the investment landscape. Really are a better mousetrap, and it's why they've proven so popular. So I'll now just give you go into how the industry is going, just to demonstrate that strength. And so if we look at the next slide. the strong growth. So globally, there's now about $4.8 trillion invested in ETFs. So let's say the word ETF. I mean, when I say ETF, I mean, or in this case, ETFs. 4.8 trillion around the world. Very strong growth, and even last year, still growing strongly. There was 36% growth in ETF funds under management last year globally. Just go to the next slide. And again, on the ASX, on the New York Stock Exchange, for example, ETFs now account for something like 30% of trading that goes on the market. So they are quite actively traded. And the largest ETF globally actually trades 4 times the daily volume as the value of Apple, the stock of Apple, for example. So it just shows you how active that is. And in the US, 52% of US investors intend to invest in ETFs in the next 12 months. So, the US is really further along the path in terms of using ETFs than Australia. They've been around a lot longer in the US, and I guess it's a lead indicator of where our market will probably head. And if you look at our market, again, very strong growth from a low base. Just have a look at the next slide there. So at the moment in our market, there's almost 40 billion in funds under management. There's actually 37.9 billion as at the end of April in all the various ETP products. And I'm using the term here ETP in that broad sense of actively managed, passively managed rules-based funds. And again, just only last year had 34% growth in funds under management. So very strong growth, albeit, but again, as a percent of total funds management in Australia, it's still pretty small. So it's growing, albeit from a low base. Excuse me. So what are the type of investors, who is investing in ETFs in Australia? Now, we subscribe to a regular survey, an annual survey that comes out that does basically go out and try to ascertain what are the types of people investing in ETFs. What I can tell you is that at the moment, the average age is about 49. Sorry. So I've got a frog in my throat. So sort of a mid, still, I guess, in the asset accumulation stage. 1 in 4 are retired. So, a big part of the market are retirees looking for, I guess, some income opportunities and relative capital stability, I guess, in your retirement. And again, there are a lot of ETFs that do provide that opportunity. Self-managed super funds have been a big part of the growth in the ETF market. So basically 1/3 of investors, Australian investors in ETFs, are basically self-managed super funds. And again, the survey indicates, strong intent to reinvest in ETFs in the coming years. So almost 6 out of 10 of those that hold ETFs that were surveyed intend to invest in more ETFs next year. So again, self-managed super funds, those are looking to grow their some growth opportunities, but also retirees looking for some income, presumably looking for some income opportunities and some relative stability of returns for those in retirement. What's also, I think, a pleasing feature over the last few years in particular has been growing interest amongst the younger generation, let's say, the millennials. So if you look at the next slide there, again, the surveys show that millennials, Gen Xers and baby boomers, there's actually more millennials that are expressing interest in investing in ETFs in the coming year than baby boomers. So that that shows that in fact, you look at it, the average age of an ETF investor has been declining in recent years. I guess it's fair to say the early adopters here were self-managed super funds, those probably in the mid to late part of their investment cycle, the baby boomers. But it's now being embraced by more and more younger generations as well. So let me now turn to how to, what are some of the opportunities in the ETF market? How can you get your, as I said, a lot of you already seem to have invested in ETFs, but there's maybe 40% of you that haven't yet dipped your toe into the market, so to speak. So let's just go through a few ideas. Firstly, this is our flagship fund. So I'll go through it in 3 stages: Australian equity opportunities, Australian income, and then some international exposures. Now, firstly, in terms of Australia, this is our flagship fund, I guess you'd say, the FTSE RAFI Australia 200 Index, and the code there is QOZ. And as I said, this is an index fund. It basically tracks an index, but the unique feature of this index is the stocks are weighted not by market capitalisation, not by their price, but by basically an averaging process, taking into consideration their book value, their earnings, cash flows and dividends. And basically what that does is it tries to generate an underlying, I guess, value for that stock, an underlying sense of its size in the market, not taking into account of the actual current market price. And the effective result of that is that it basically tends to overweight stocks that are relatively cheap, in the sense that, you know, their prices are high relative to. So basically, compared to a market cap index, so say compared to an ETF that tracks the popularly known S&P ASX 200, compared to that, our fund will tend to overweight stocks that are relatively cheap and underweight stocks that are relatively expensive. And by relatively cheap, I mean trading at high prices relative to their underlying financial metrics like sales and dividends and whatnot, and cheap where the prices are relatively low. So the beauty of that is that we know that high-priced stocks tend to underperform eventually over time, and relatively cheap stocks tend to outperform. So the nature of that basically means that this index, which has been around for a while, tends to outperform the ASX 200 over time. In fact, the average outperformance is something like 2% a year. It doesn't do it every year. There's a few. Every now and again, you get periods where high-priced stocks continue to rally strongly because we might be in a bubble or something like that. Or relatively cheap stocks are still being unfairly sold down, in which case, you know, there will be the odd year in which it does underperform. But historically, over time, it does outperform. And in fact, if you actually compared the RAFI index to actively managed funds, there's some surveys out there that look at the performance of actively managed funds. It would have been in the top tier of funds consistently on a 5 year basis. So, you know, we like this fund. I think it's a great fund for a relatively low management fee. You should over time be able to, or certainly historically at least, and we think there's good reasons why going forward it should continue to outperform the ASX 200.
And what was the code of that fund again, Dave?
Yeah, so the code there is QOZ. QOZ. So there's a way of getting passive, low-cost exposure to the management fee, 40 basis points. So again, management fee about 40 basis points. The average management fee for an actively managed fund, according to the Morningstar, according to noted industry surveys, is around about 1.5%, would you believe? Now, there's another fund we've recently introduced. For those that are so 40 basis points is pretty cheap, but you know what? We've actually got one that's even cheaper than that. We've got one that's 7 basis points. And these are for investors that are happy with broad market exposure. Maybe they're a bit dubious about whether the RAFI strategy that I've outlined can outperform in the future. You know, they just want that sort of market type cap exposure, and or they're very cost conscious. So we've brought to market the A200 ETF. Now, this is a market cap index. It's weighted the top 200 stocks by market capitalisation. It is a little bit different to the ASX 200, so it's not strictly the same index. It's similar to that index, but it's not the same. We basically have different rules in terms of when we include and exclude companies over time. But broadly over time, you should get a return similar to something like the ASX 200. But the beauty of this fund is that it's very, very cheap, 7 basis points. So when 7 basis points, just to remember, that is 0.07%, 0.07% fee. And we've just got an example there of how the difference of fee, how that what the impact that can have over time. So, for example, this is an extreme example, but if you invested $10,000 and you invested in an actively managed fund that basically tracked the market, and you paid a management fee of the industry average 1.5%, after 40 years, in real terms, the value of that fund, if it goes up by 5% a year, would be around about $38,000. Not too bad, after 30 years. That's in real terms. But if instead you invest in the A200, which charges only 0.07% a year, over 40 years, that would be worth almost $70,000, $68,000. The difference is 77%. So, it's a huge difference, I guess, accumulated over time. It just shows the impact there. So again, so for particularly, say, younger investors, they've got a lot of time, a long time horizon. They want low-cost passive exposure. You really can't go past the A200 in that regard. So that's the second, I guess, opportunity I wanted to share with you. The third one is, particularly given the current market environment in Australia, is what we call the X20 index. Now, one of the challenges of the Australian market at the moment is that the top 20 stocks in the country tend to be the big banks and the big miners. The miners have been doing okay, but I think they're very beholden to commodity price developments, and certainly the big banks have been in a world of pain, because of the Royal Commission. There's a lot of regulatory risks facing the banks. You've got the credit cycle turning. You've got a slowdown in housing activity. So basically the top 20 stocks have been struggling to generate particularly good returns. But actually underneath that, some of the mid-cap stocks in the market have actually been doing reasonably well. Problem is that the top 20 are a big chunk of the market. So if you want here, I guess basically our X20 index is again essentially the ASX, the top 200 stocks in the country less the top 20. So you're getting access to the 180 stocks that remain outside of the top 20. And as you can see, that fund, that grey line there, that's what the X20 index has done over time, and it generally outperforms the market. And certainly in the last few years, it's showed pretty good growth because, again, the mid-cap part of the market, or those stocks outside of the top 20, have been doing a lot better. So it's a low-cost way of getting exposure to some of the smaller cap, or not necessarily the small cap, but the mid-cap parts of the market. So that is the X20 index. So EX20 is the code, if you may have interest in that. So there are some Australian equity ideas for you. Now I'll just share with you some income ideas. And again, one of the benefits of our market, I guess, overall has tended to underperform global markets of late, because our banks have struggled, also because of the downturn in commodity prices, and also we're not, but one of the features that we do have is that our income opportunities are still pretty good. So the dividend yields in Australia are still quite attractive by global standards. Interest rates in Australia are still, somewhat higher than certainly in areas like Europe and Japan. And the other feature that ETFs are bringing to market more, fixed income opportunities that otherwise would have been harder to access. And I'll go into some of those in a minute. But just to reiterate, again, a common question asked about ETFs is, do they pay income? Those that are not familiar with what an ETF was. And so let me just say here, yes, they do. Just like a managed fund. So they do pay regular income distributions, which can vary from monthly. Some of the popular income ones that we have are pay monthly, or they could pay quarterly, semi-annual, and some even pay on an annual basis. But they basically do pay regular income, but on a different sort of time period. And not only that, they can pass on franking credits. So again, if there are a lot of ETFs that do invest in companies that generate franking credits, as with any managed fund, they are then passed through to end investors. So we'll give you a statement at the end of the year indicating how many franking credits you're eligible for, and you can take that along to your accountant when you do your tax return, and subject to your situation, get a tax credit, or even get some cash back from the ATO, provided that rule continues. So what are some of the income opportunities? So this is just a handy chart that looks at the different income yields or income returns as of the end of March. I'll just go through the top one, some ideas there. The top one there that I've got there is the top 20 equity yield maximizer. That's YMAX. So that's that fund I talked about earlier, which basically invests in the top 20 stocks, but then it basically sells calls against those stocks, and when you sell calls, you basically generate income. When you're selling a call, you generate income, option premium, and that adds to the income return of that fund. Now, when you sell, basically a call is the right to buy a stock at a future price, at an agreed future price. So I guess the quid pro quo of that approach is that when you sell a call and stocks rally strongly, you lose some of the upside return potential of those stocks. And in a very strongly trending market, you're going to give up some of the capital return by selling calls in that regard. But in a flat, and certainly in a flat to sideways to down market, you don't give up that upside because it's not there, and you just pocket the income as a result. So anyway, the return on that over the year to end March has been about 10%. So it's quite a handy income return for that fund. Another one, there's an equity opportunity. Again, if you want to save paperwork and you do like the yields that banks offer, we have an ETF, QFN is the code, that gives you access to the ASX 200 Financials Index, a big chunk of which are the top 4 banks. And again, they're offering quite a attractive grossed up dividend yield of around about 8% as at end of March. But that does give you equity risk. Of course, if bank stocks rise and fall, the market price of that ETF will rise and fall accordingly, but you're getting paid a decent income in exchange for that. Now, 3 others I do want to highlight are some of our cash and bond products. So firstly, right at the bottom there, we've got something called the High Interest Cash ETF, AAA. And again, it generally yields something like 0.5% above what the RBA cash rate is. So the RBA cash rate in Australia is about 1.5%. And basically that fund is able to generate a 2% return. What does that fund invest in? It invests in basically bank deposits, some at-call deposits, some term deposits, but a mix of bank deposits. Then it collects that income and then distributes it back to investors on a monthly basis. So that's the cash ETF. So a very handy way of investing in bank deposits. If that's what you like, you can do it on the ASX and it's all there available in your portfolio. But the other ones are, if you want a bit more income, we have a floating rate note ETF. So that's basically bank bonds, but the yield on those do float in line with the market. Again, in the interest of time, I won't go into it too much. If you want more information on that, definitely go to our website and look it up. But the key issue here is it pays a decent extra income kicker of something like 3%, close to 3% as of the end of March. And the thing about it is that the capital, it's a very relatively stable capital return over time. So the capital volatility of this is considerably less than investing in shares, for example. You don't get as high a return, but it's better than having your money, under the mattress, for example, or in a bank deposit or whatever. The other thing I'd highlight there is that coupon at 3% is very attractive compared to bank deposits. And again, with a term deposit, for example, 1 year, 6 month term deposit, you've got to lock your money up for 6 months or 1 year. If you invest in something like coupon, if you want your money back, you can basically sell the ETF and get your money back in T+2 because, the market, there's T+2, liquidity on the ASX. So when you sell an ETF, the money's back in your bank account within 2 business days. So you get that yield, you get a better yield than term deposits, and better liquidity, better access to your money. So really it's a no-brainer to my mind in that regard. The other one is bank hybrids. And again, I won't go into the details in the interest of time, but we have a fund that's basically invested in bank hybrids. And we know that bank hybrids pay a relatively attractive income over time. And plus you get franking credits with hybrids as well. And in fact, as at the end of March, the yield on that was about 5.4% grossed up for franking credits. So good, an easy way to invest in bank hybrids. And you get, again, diversified access to a whole number of hybrids all in that one fund. And again, we have a lot of information on the website there. But so there's some income opportunities. Again, if you got your money sitting in a mattress or in a bank account, the key message here is there's a lot of innovative ETFs out there that can give you pretty good capital stability if that's what you're seeking, and a reasonably decent income return given that capital stability. And just to dig into that a little bit of just to highlight, for example, our cash ETF. Just mention that, the 2% yield, very competitive against a lot of bank deposits. I'll just conclude now with some international investment ideas. And again, a lot of Australian investors, they may well have a portfolio chock full of Australian stocks. Not a lot of international exposure. It's been hard to get that exposure. Before ETFs came along, you'd have to invest in an international fund. You'd have to set up an international broking account or something like that to invest in stocks directly. Now with ETFs, you can get that international access. So just a few examples I want to share with you. Firstly, the NASDAQ index. Again, this has been a standout performer over recent years. The global technology sector has been doing very well. And it gives you access to, some of the top technology names around the world. Apple, Google, Facebook, Microsoft, Amazon, all wrapped up in this one convenient fund, NDQ. And also, so that's, I won't say much more about that one. Again, if you want more information, it's available on our website. I've done a number of blogs of late talking about the NASDAQ index. And another one is a global healthcare ETF. It gives you access to the global healthcare companies around. Sorry, before I get on to healthcare, just to highlight, we do have a lot of different sector funds out there that give you access to different industry sectors around there. So, for example, fuel producers, global gold miners, global financials, global banks, food companies, drug, which is global healthcare companies, and the last one there is HACK. HACK is basically a fund that invests in the top global cybersecurity firms around the world. And, given the spate of hacking that's going on and the concerns about data privacy and whatnot, demand for cybersecurity around the world is just going through the roof. And so we've created that fund to basically tap into that growth opportunity. So if you want more information, definitely go to our website and have a look at it. And just to, and again, one from a long-term investment perspective, one that I kind of like of that is it's healthcare. And again, this is a long-term growth opportunity. We know that demand for healthcare is growing around the world. The share of GDP in countries around the world devoted to healthcare is rising. And so, getting access to the top healthcare companies around the world through the ETF drug, that's the code DRUG, is a handy way of getting access to that growth opportunity. Look, there's a lot more information on our website. I'm out of time, but definitely if I've whet your appetite for investing in ETFs, definitely visit our website. We've got a lot more information on all the different opportunities that we offer.
Fantastic. So yeah, we have slightly gone over time, but I'll try and maybe spend 5 minutes just going through some of the key questions. There has been a huge number of questions. It's definitely an area that is interesting to people. So we'll just maybe for 5 minutes answer some of them. There's been way too many. We'll have to get back to you via email. Also, just to quickly say, on the screen right now, you'll see there is a number of ways you can get updated about ETFs and learn more. Our website is the key one, and we've got a section there called Insight where we do, in fact, have a number of simple 101 style articles to learn about ETFs, and that's called the BetaShares Academy. But also you can sign up to regular insights from David. He's got a regular economic insight as well as a weekly newsletter. And of course, we're on all the major social networks. Now, with that said, I'll try to get to some of these.
Yep.
Ooh, a lot of questions. Look, I think probably one of the key questions we didn't get to, David, that was asked is where are the assets of the ETFs held? And so therefore, if for example something happened to the ETF issuer, would something happen to the assets of the ETF?
Well, they're held in trust by a third-party custodian, essentially. As basically the way the regulations work in Australia are asset-regulated managed funds. The funds are held in trust. The assets are held in trust by a third-party custodian, such that if anything were to happen to BetaShares, for example, they are ring-fenced. They're not a part of the balance sheet of BetaShares. Either another manager would then take over that fund, or be appointed to manage that fund, or, in the worst case scenario, the actual fund would be wrapped up, the underlying securities in that fund would be sold on the market, and the funds, return to investors. So that's the way it works. And again, it's no different from other managed funds, that aren't ETFs but are regulated by ASIC in Australia.
Great, that's great. And
should I say?
No, that's all right. And so I'm just trying to think about, there's obviously a number. One question is I thought was quite interesting is, if there's two ETFs that are, say, tracking the ASX 200, how come the price is different between the two providers? In other words, is the price actually meaningful in this particular case?
Well, the short answer is the price isn't really meaningful. You'll find that the prices of the two should basically move together quite closely, but one could be, $20, one could be $10. It's really just the way they've done the unit pricing. Because at the end of the day, I mean, if it's $1 million in a fund, whether it trades at $10 or $100 or whatever, it's just a function of how many units you put out into the market. So the actual price per se isn't really the meaning. It's the same with so that's the answer. It's not really meaningful, but you'll find that they do track each other. They should track each other pretty closely over time.
And another question here is it possible to reinvest dividends in an ETF?
Yes. Many do have what's called a dividend reinvestment program. So you can basically elect to have any dividends reinvested in new units of the fund. So yes, that's definitely an opportunity there.
Yeah, cool. Well, look, we have gone over time. We don't want to keep people. We did have a huge deluge of questions, which we'll aim to answer in email to the extent we haven't answered those. But it seems as though there's definitely a desire and interest in this type of information. So it's probably something that we'll be doing more frequently given the level of interest. And we look forward to hearing back from you. There will be a short survey at the end of this where you can tell us what other types of information you may be interested in. And we thank you all very much for your time. Thank you, David, and thanks everyone for attending.
Thank you, everyone.